In 2022, American banks collected $15.5 billion in overdraft fees alone. Not interest, not service charges, not investment returns, overdraft fees. From people who didn't have enough money in their accounts to cover a transaction. The banks made $15.5 billion from the single most financially vulnerable moment in a person's month. And the remarkable thing isn't the number. The remarkable thing is the engineering behind it. Because overdraft fees don't happen randomly. They are the output of a system that was deliberately designed not to catch you failing, but to create the conditions in which failure becomes statistically inevitable for a predictable percentage of customers. Every month, like clockwork, you are not failing the system. The system is working exactly as it was built to work. The account. You think you understand you have a checking account. You know roughly how it works. Money goes in, money goes out. If you spend more than you have, something bad happens. What you probably don't know is that the bank has at least 4 separate revenue streams running on that single account simultaneously, and 3 of them are invisible to you during normal use. The first one you know about, monthly maintenance fees, account minimums. Wire transfer charges, these are visible. They're on the fee schedule. You were handed during account opening and never read again. The second one you know exists, but don't think about, your deposits. When your paycheck lands in your checking account, the bank doesn't put it in a drawer with your name on it. It immediately puts that money to work, lending it to other customers, investing it in short-term instruments, using it as the capital base that funds their entire lending operation. They are making money on your money every single day it sits in your account. In exchange for this, they pay you interest. On a standard checking account, that interest rate is currently somewhere between 0.01% and 0.08%. The national average savings account rate as of recent years sits around 0.5% at traditional banks. The Fed funds rate, the rate at which banks borrow money from the Federal Reserve, has sat significantly higher. The spread between what banks pay you for your money and what they earn by using it is one of the most consistent profit margins in the history of American finance. But neither of these is where the engineering gets interesting. The invisible hand in your transaction history here is something most people have never been told about: how their checking account actually processes transactions. When multiple transactions hit your account on the same day, the bank has a choice about what order to process them in. Chronological order, the order in which the transactions actually occurred, is one option. Highest to lowest dollar amount is another. For years, the majority of large American banks processed transactions in highest to lowest order. Not because it was simpler, not because it was more accurate, because of what it did to overdraft frequency. Picture an account with $200 in it at the start of the day. 4 transactions occur: $180 for rent, $12 for groceries, $8 for coffee, $14 for gas. In chronological order, the rent clears, leaving $20. The remaining 3 transactions all clear, 0 overdrafts. In highest to lowest order, the $180 rent clears first, leaving $20. Then the $14 gas clears, leaving $6. Then the 12 groceries attempt to clear against $6. Overdraft, fee. Then the $8 coffee attempts to clear against a negative balance. Second overdraft, second fee. Same account, same transactions, same day. 0 overdrafts versus 2 overdrafts, depending entirely on a processing order decision made by the bank that you had no knowledge of and no input into. Wells Fargo was sued over this practice and paid $203 million in settlements. Bank of America paid $410 million. TD Bank paid $62 million. They paid the settlements. Then most of them quietly continued variations of the practice, because even after the settlements, the revenue generated by overdraft engineering exceeded the cost of the litigation. This is not a bug in the banking system. This is a business model, the feeling they're selling against now. Here is where the psychology arrives, and it is more deliberate than most people are comfortable knowing. Banks spend significant resources studying what is called financial anxiety response, the specific emotional and behavioral state that humans enter when they feel financially stressed. What researchers have consistently found is that financial anxiety does not make people more careful. It makes them less careful. When you are stressed about money, when you're checking your account repeatedly, when you're doing mental math while standing in a grocery store, when you're 3 days from payday and calculating whether your balance can cover an unexpected expense, your prefrontal cortex, the part of the brain responsible for planning and rational decision-making, is functionally compromised by the cortisol load of that stress. You make worse decisions when you feel poorest. You are less likely to check the fine print, less likely to comparison shop, less likely to notice the fee that was quietly added to your statement, less likely to contest a charge that doesn't look right, more likely to accept an overdraft protection product you don't fully understand, more likely to take a short-term loan at a rate you would never accept if you were thinking clearly. Psychologists call this the scarcity trap, a term developed by behavioral economists Senthil Mullainathan and Eldar Shafir after years of studying how financial stress affects cognitive function. The scarcity trap describes a state in which worrying about not having enough money consumes so much mental bandwidth that it actively reduces your capacity to make the decisions that would improve your situation. You are not bad with money when you are in the scarcity trap. You are cognitively impaired by the experience of not having enough, and the banking system, not through conspiracy, but through the compounding logic of profit optimization, has evolved to extract maximum revenue from customers at exactly the moment the scarcity trap has them most vulnerable. The overdraft fee hits when the balance is lowest. The loan offer arrives when the stress is highest. The fine print is densest in the product designed for the customer with the least time and mental space to read it. This is not accidental. The product designed for your worst month overdraft protection sounds like it was designed for you, and in the way it's marketed, as a safety net, as coverage, as protection, it genuinely sounds like a service. Here is what it actually is. When you opt into standard overdraft coverage, the bank agrees to cover transactions that exceed your balance rather than declining them. In exchange, they charge you a fee, typically between $25 and $35 per transaction. If your balance is negative and you don't bring it back above zero quickly enough, many banks charge an extended overdraft fee, an additional daily charge simply for remaining negative. Now consider what this looks like at an annualized interest rate. If you overdraft by $50 and are charged a $35 fee, and you bring the balance back to zero within a week, the annualized interest rate on that $50 advance is approximately 3,650%. Not 36.5%, 3,650%. Payday lenders, an industry that has been legislated against in dozens of states for predatory lending practices, typically charge between 300% and 400% annualized. The overdraft fee offered by the most mainstream and federally regulated financial institutions in the country is approximately 10 times more expensive than a payday loan by the same metric, and it is sold to you as protection. The customers who pay these fees most frequently are not irresponsible people. They are people whose income timing doesn't match their expense timing. Paycheck arrives on Friday, rent is due Wednesday. The math is not a character flaw. It is a cash flow timing problem that the overdraft system is perfectly positioned to monetize. Every month, with mathematical reliability, the quiet one's overdraft fees are the visible edge of this system. But the more durable revenue streams are the ones you never think about. The minimum balance requirement keeps a specific segment of customers permanently unable to move their money to a higher yield account without triggering a monthly fee. The fee is small enough that most people absorb it rather than restructure their banking. The bank collects it indefinitely. The low savings rate, your money earns 0.01% in a traditional savings account, while the bank earns multiples of that rate by deploying it. The spread is the product. You are not the customer in this transaction. You are the inventory. The credit card attached to your account. The average American credit card interest rate currently sits above 20%. For customers who carry a balance, which is the majority of card holders, the bank is collecting 20 cents on every dollar of debt every year. The rewards points, the cashback, the airline miles, these are funded by the interest paid by the customers who can least afford to carry a balance, redistributed as perks to the customers who pay in full every month and generate the least profit. The financially stressed subsidize the financially comfortable. This is not a side effect of the credit card system. It is the architecture of it. What actually changes things, the mistake most people make after understanding this, is directing the energy at the bank. The bank is not a villain. It is a system optimized for profit operating within legal boundaries. Being angry at it is like being angry at a river for flowing downhill. What changes your relationship with this system is not anger. It is removing yourself from the conditions the system is designed to exploit. The overdraft problem is solved by one thing and one thing only: a buffer, not a large one. Most overdraft incidents involve transactions under $50. A $500 buffer in your checking account that you treat as zero eliminates the majority of overdraft exposure permanently. You are not saving $500. You are buying yourself out of the most expensive product the bank offers. The savings rate problem is solved by moving. High-yield savings accounts at online banks currently offer rates between 4% and 5%. On the same money, your traditional bank is paying 0.01%. On the money moves in 2 business days. The account takes 15 minutes to open. The reason most people haven't done this is not that they don't know it exists. It's that the friction of switching feels larger than the benefit when you're already financially stressed, which is exactly when the scarcity trap has the most grip. The credit card problem is solved by understanding which side of the business model you're on. If you carry a balance, you are the product. The rewards are not for you. They are funded by you and paid to someone else. Paying the balance in full monthly is not just financial advice. It is the only way to use a credit card without transferring wealth upward. The cognitive bandwidth problem, the scarcity trap, is the hardest one to solve because it requires solving it while you're inside it. The most useful intervention research has found is automation. Remove as many financial decisions from your active attention as possible. Automate savings transfers, automate bill payments, not because you are incapable of managing these things, but because every financial decision you make while financially stressed is being made with compromised cognitive capacity. Automation makes the decision once, clearly, and then removes it from the rotation of things your anxious brain has to manage. In 2022, the year American banks collected $15.5 billion in overdraft fees. The top 4 banks in the United States reported a combined net income of over $100 billion. That number is not an indictment. It is a description of scale. The banking system is not designed to make you poor. It is designed to make money. And the most reliable way to make money from a mass-market financial product is to build it around the behaviors that financially stressed people reliably exhibit. The checking account, the overdraft product, the savings rate, the credit card, none of these were designed around your best month. They were designed around your worst one. And your worst month comes with a predictable regularity that the system has already accounted for. The question is not whether the system is fair. The question is whether you understand which parts of it are running on you right now, because the $15.5 billion didn't come from nowhere. It came from $35 at a time. From people who were already having a bad enough week that they didn't notice until it was too late. The bank didn't make money because you were careless. It made money because you were stressed, and stress, it turns out, is the most bankable emotion there is.